Today we're going to dig into the latest quarterly results from Mapletree Panasia Com Trust, or MPACT for short. And what we found inside their Q2 numbers is a fascinating little puzzle, a real head-scratcher.
Okay, so let's just get right to it. The big question we're tackling in this explainer is this. How is it possible for a company's core income to actually fall while at the same time the cash it pays out to its investors goes up? I mean, it sounds completely backward, right? But that is exactly what just happened with MPACT.
And here it is laid out for you. This slide shows the paradox perfectly. On one side, you've got net property income, or NPI. That's basically the profit they make from their buildings. That went down 2.2%. But then look at the other side. Distribution per unit, the DPU, which is the actual cash in hand for investors, that went up 1.5%. So less income, but a bigger payout. Let's unpack how they managed to pull this off.
So here's our game plan for solving this little financial mystery. First, we're going to take a closer look at those surprising numbers. Then, we'll see how their Singapore properties were the absolute star of the show. We'll get into the overseas challenges and why they sold some buildings. Then, and this is the key part, we'll reveal the cost-cutting playbook. After that, we'll look at how they're shoring up their finances. And finally, we'll talk about what's next for MPACT.
All right, let's dive into Section 1. The surprising numbers. It's time to really get into the weeds and see the data that created this whole contradiction in the first place. Now, this is where the story really gets interesting. Just look at the top two lines. Gross revenue, down 3.2%. Net property income, down 2.2%. So less money is coming in the door. But then, your eyes jump right to the bottom line. Distribution per unit is up 1.5%. How? Well, the clue, the smoking gun, really, is sitting right there in the middle. Finance expenses. Just keep that in mind. So, just to make sure we're all on the same page, when we talk about net property income, or NPI, you can basically think of it as the raw profit from the buildings themselves. It's the rent they collect minus the direct costs of just keeping the places running, things like maintenance and property taxes. It's a super important number for figuring out how healthy the actual real estate is. And distribution per unit, or DPU, well, this is the number you really care about as an investor. This is the cash that actually shows up in your account. For a REIT like MPACT, this is pretty much the main event. And the fact that this number went up while their property income went down is what makes these results so darn interesting to look at.
Okay, let's move on. While the overall story was a bit mixed, there was one part of the business that was just absolutely crushing it. Let's talk about Singapore. The star performer, the real engine room of MPACT's entire portfolio.
Let's just start with this number, 100%. That is the committed occupancy for VivoCity, which is Singapore's biggest mall and it's MPACT's crown jewel asset. I mean, think about that. In today's retail world, to be 100% full, that is a huge statement. And believe it or not, it gets even better. Not only is VivoCity totally full, but when they renewed leases with tenants, they managed to hike the rent by an average of 14.1%. That's called a positive rental reversion, and it just screams that demand for their space is incredibly high.
So you see, VivoCity's strength wasn't a fluke. People are spending more there. Tenant sales were up almost 5%. They just finished a huge renovation, opening up a whole new retail area that's already expected to be a big moneymaker. All of this success meant that if you isolated just the Singapore properties, their net property income actually grew by a really healthy 6.1%. This strength at home was absolutely crucial.
Okay, so if Singapore was firing on all cylinders, where did the overall drop in revenue come from? Well, that brings us to Section 3. This wasn't about things going wrong everywhere. It was about making smart, deliberate choices to kind of prune the portfolio for better health in the long run.
So that dip in revenue really boils down to three things. Yeah, there were some lower contributions from overseas properties, but the two biggest reasons are actually about what's missing. See, when you sell a property, its income vanishes from the next year's comparison. So the income from Mapletree Anson, it's gone because they sold it. Same story for two office buildings in Japan that were also recently sold. And here are those deals in black and white. You can see that within just 1 week, this past August, they sold off two of their office buildings in Japan. This is exactly what the CEO means when she talks about actively refining the portfolio. They're getting rid of assets that aren't central to their main strategy. Now, yeah, that causes a short-term hit to revenue, but as we're about to find out, it was all part of a much bigger, much smarter plan.
And that brings us to the main event, Section 4, the cost-cutting playbook. Folks, this is the secret weapon. This is the answer to our paradox and the real reason investors got a bigger check this quarter.
You know, this really is the whole story in a nutshell. To find the extra cash to pay out, they didn't look at the money coming in. That was going down. No, they looked at the money going out. They got absolutely ruthless with their cost control, and boy, did it pay off.
And boom, here it is. This chart shows the single biggest move they made. Just look at that plunge in finance expenses, their interest payments, from $56.6 million last year down to $47.4 million this year. That's a massive 16.4% drop. We're talking about more than $9 million in savings in just one quarter, just from managing their debt better. That money went straight to the bottom line, giving them the firepower to raise the payout.
So how'd they do it? It was a really smart three-part strategy. First, remember those buildings they sold? They took that cash and immediately used it to pay down debt. Simple, right? Less debt means less interest. Second, they took advantage of some favorable interest rate conditions, which probably means they refinanced some loans at better rates. And third, they also managed to cut their day-to-day operating costs by almost 6%, thanks in part to lower utility bills. It was just a masterclass in financial discipline. Now, all these moves weren't just a short-term trick to make one quarter look good. They were all part of a bigger plan. So let's move to Section 5 and see how they're fortifying their balance sheet and building a stronger foundation for the future. And this chart really just says it all, doesn't it? Look at that huge blue slice. Singapore now makes up 57% of their total $15.9 billion portfolio. This is their fortress. By selling off assets in other places and doubling down on their strongest market, they're creating a much more stable and predictable business. And the health report card looks pretty good. Their leverage ratio, think of it like the loan to value on your house, but for the whole company, is down to a very comfy 37.6%. Their earnings can cover their interest payments 3 times over, which is solid. And this is key. Almost 78% of their debt is at a fixed rate, so they're protected if interest rates spike. Plus, with nearly $1 billion in cash and credit available, they have a lot of flexibility. All right, so let's bring it all home with our final section, the road ahead for MPACT. What does all of this tell us about where they're headed? You know, you don't have to take my word for it. The CEO, Sharon Lim, summed it up perfectly. She says the results validate their approach. And what is that approach? It's all about using the incredible stability of their Singapore properties as an anchor, which gives them the strength to deal with challenges elsewhere. It's about smart management, selling the right assets, cutting costs, and paying down debt. It's a very clear, very disciplined strategy.
And so we end with this one big question. This strategy, selling off some assets to cut debt and slash costs, it clearly worked. It delivered a bigger payout to investors even when revenue shrank. It created stability. But is this the best path for long-term growth? Or does a company also need to be buying and expanding to really create value down the road? That's the strategic tightrope that MPACT's management has to walk from here on out.